Hi guys, welcome back to this week's Technical Insights. I'm doing this video on a Thursday night or early Friday morning after the US market closed. There are three reasons I chose to do this video at this time. Number one, the Dow Jones Index run of 13 consecutive winning sessions came to an end today, and that could be a sign of a reversal. The Fed has raised interest rate by a quarter percentage point higher the day before, and the US GDP grew at an annual rate of 2.4% in the second quarter, up from the 2% in the first 3 months. The Dow Jones Index finally fell on Thursday after ending a streak of 13 consecutive winning sessions. The Dow Jones Index run of wins was the longest since 1987 and is the second longest run on record. The index fell 237 points on Thursday, or 0.7% lower. If the Dow Jones Index had closed higher today, it would mark a 14-day straight consecutive rise, and that would just need one more advance to break the index all-time record winning streak. This may be the turn or the pullback of the index, which has been overly extended for quite a period of time. The S&P 500 also lost 0.64%, while the tech-heavy Nasdaq dropped 0.55%. Stocks were mostly in the green for much of Thursday's session before crashing in the later part of the day. The major indices were, however, little changed for the week, as traders and investors continued to weigh on economic strength and the much stronger earnings results that's above what many Wall Street analysts had expected. The possibility of a sharp economic slowdown has been our long-running concern for investors, as the Fed has raised interest rates to their highest level in 22 years. The Fed moved rates a quarter percentage point higher on Wednesday, and Chair Jerome Powell said that the central bank next step will depend on how the economy fares in the coming months. In my opinion, this leaves the door half open and half closed for another quarter percentage point hike in September. But this does not change my investment thesis that the Fed will continue to hike as long as economic data comes in more positive than expected. The US economy has so far steered well clear of a recession, with Thursday GDP number showing a 2.4% growth in the second quarter, and this was more than what economists had expected and had a rate higher than the first quarter growth of 2% expansion. The European Central Bank also raised rates by another quarter point on Thursday, another sign to me that the global economy is still doing well. The first sign of reversal from the Dow Jones Index was the big bearish engulfing candle, which could signal a pullback or a correction downward is likely to come. The candlestick formation shows that sellers have overtaken the buyers and are pushing the prices more aggressively downwards than buyers were able to push it up. The MACD indicator has also shown the first sign of weakness, with the MACD line converging towards the signal line. And this is on the lower MACD histogram that we observed in the past 4 trading sessions. The RSI indicator also had a significant pullback from Wednesday reading of 75. On Thursday close, the reading is now about 10 points lower at 66 points. With the above being said, Dow Jones Index is still on a predominant uptrend since the beginning of the year. The reversal that we saw on Thursday is likely a short-term pullback, and the imminent support will come in at the 20-day moving average and the Bollinger Band basis of 34,600 and the 16 June high of 34,500. To sustain the uptrend that we have seen since the beginning of the year, the Dow Jones Index needs to stay above the medium-term 50-day moving average, which is the red line that you see over here, as well as the uptrend line that you see over here, which is at the handle of 34,000. Breaking below this will be the lower bound of the Bollinger Band at 33,500, where the Dow Jones Index may move into a consolidation pattern. With that, this will be the end of this week's Technical Insights. If you find it useful, do give us a like and share, and we'll see you again next week in the next video.